Hello. So welcome to your next chapter, that is your foreign trade policy. Now I know a lot of students will skip this chapter, so I will be a little faster because this is comparatively a big chapter, so I don't want to take up a lot of time on this. So first of all, your foreign trade policy, some key features of your foreign trade policy are there. That is, your number of mandatory documents have been reduced to three. So earlier there was a long list of documents which has now been brought down to three documents. Next, the facility of 24/7 customer clearance. So now they have facility of 24/7. That means all 24 hours of the day and 7 days of the week. Next, Swift is introduced to enable importer and exporter to lodge clearance documents at a single point. So Swift is a portal where they can put all their documents online. Next, prior online filing facility for shipping bills has been provided. 7 days if transportation is done by air and 14 days if transportation is done by sea. So you'll be able to fill it prior online only. Next, EDI initiatives, that is facility for online filing of applications to obtain your IEC, that is your import export code, importer exporter code, and various scripts. So all of this basically what they're trying to say, that boss, we've reduced the number of documents, everything, we've given you the options to do online for all the documents, where earlier a lot of paperwork was involved. You do not have to remember this for exam point of view. So now what are your mandatory documents? What are the mandatory documents required in case of, first we'll study exports. So in case of exports, it will be your bill of lading, airway bill, lorry receipt, railway receipt, or postal receipt. That means by whichever way you are sending it, you will require that documents. Your bill of lading, airway will be for air, lorry receipt if it is by train, your railway receipt is also by train, postal receipt if it is you are couriering or it is by baggage. Okay. So for export and import, this point is common. Now, next is your commercial invoice come packing list. That means whatever you are sending, an invoice come packing list. So it is the details of what all things you have put inside this cargo. And only thing different for exports and imports is, for export there has to be a shipping bill or bill of export. How, while for import, this is also based on the mode that you are sending the goods, shipping the goods. And import, in case of imports, it will be of course your bill of entry. Okay, so these are your mandatory documents that are required for your exports and imports. Next is your provisions relating to imports. So now what they have done, they have bifurcated some things, that something will be freely allowed, some will be allowed as per authorization, and some will not be allowed at all. So in case of second hand goods, first that we are studying is your second hand goods. Now second hand goods, if they are capital goods, if there are any second hand capital goods that you are importing, capital goods are allowed to be imported freely. Why? Because they want that you import capital goods, you start production in India, so therefore there is no conditions on those. Next is your personal computer, then is your laptop, then photocopy machine. So I've also put images here so that you remember, while even during the exam you just remember the photos and you will remember what all is there. So your laptop computer. Next is your photocopy machines, then is your air conditioner. Your diesel generating sets are allowed only against authorization. That means you will be allowed to import these only if you take proper authorization. And next is all goods other than capital goods to be imported only against authorization. Okay. So basically only capital goods is allowed freely. Anything and everything other than capital goods will be allowed only against authorization. This they have separately mentioned, therefore I have mentioned, but basically what you have to remember is capital goods, second hand capital goods allowed to be imported freely. Second hand, all other goods will be imported only if there is proper authorization. Next, second part is your scrap or waste from your SEZ. Okay, so waste or scrap generated during manufacturing activities of SEZ unit or developer allowed to be disposed in your DTA freely subject to custom duty. So this you will be allowed to dispose. However, custom duty will still be payable. Okay. So what are they saying? That you are allowed to dispose, but custom duty will still be payable. Now, why is it separately SEZ? Because SEZ are considered as a territory not in India. So if any scrap or waste we are dumping, so of course that will not be in your SEZ unit. So therefore, in such a case, it will be considered as an import. So this is allowed but subject to custom duty. Okay, now third is your gifts and samples. So gifts and samples are actually prohibited. All gifts and samples are prohibited. So for second hand goods, what did we do? Capital goods freely allowed. All other goods only against authorization. Scrap waste allowed, but you have to pay custom duty. Third is gifts and sample. Gifts and samples, all of them are prohibited except two items. Two items. Your first item is your life-saving drugs. That means your medicines. Any medicines, any medical related drugs which are life-saving is your first exception. And second exception is your Rakhi. Now, what you have to remember in this, Rakhi is exempt. Only and only Rakhi is exempt. Any gifts relating to the Rakhi, that will not be allowed. That will be prohibited. Okay. So only your life-saving drugs and your Rakhi is allowed, but your any gifts related to the Rakhi will not be allowed. So that means all of them are prohibited. Then your fourth is your re-import of goods repaired abroad. Re-import of goods repaired abroad. So these goods you had sent outside India to get them repaired, and now you are re-importing them. So in such a case, your capital goods, equipment, components, etc. sent abroad for repair. If they have been sent abroad for repair, testing, quality improvement, and then re-imported, this is allowed without an authorization. That means you can send goods outside India, get them repaired, and then you can get it back India. You do not need any authorization. Okay. So this entire thing that we are doing, we are only doing to study that boss against which things are allowed, which things are prohibited, and against which things are require authorization. Okay. So re-import of goods repaired abroad, you do not need any authorization, which means it can be imported freely. And last is your import of goods used in project abroad. So any project was undergoing outside India, so you send goods from India to outside India. And then when the project is over, you are again importing the goods in India. So in such a case, what do you have to do? So after the project is completed, once the project after outside India is completed, contractor may import without an authorization. That means there is no authorization required of the goods or capital goods used in the project, provided they were used for a period of more than 1 year. So these goods you will be allowed without authorization only if they were used for a period of 1 year or more in that project. Okay, so these were your provisions relating to imports. Now we are doing your provisions relating to exports. Now provisions relating to exports, first is with regards to samples. So exports of bona fide trade and technical samples of freely exportable items, that means which are not restricted. So I sample the freely exportable items allowed without any limit. There is no limit on this. Everything is allowed. It can be exported as a part of passenger baggage without authorization. That means it can also be sent via baggage and there is no authorization required. So this was with regards to samples. Second is with regards to gift. Now gift, there is a condition. Important point, they ask this in MCQ, so please make sure you are listening to this carefully. So gifts are allowed without authorization up to rupees 5 lakh per annum. When we say up to rupees 5 lakh per annum, means 5 lakhs or less. So gifts are allowed without authorization. This limit you have to remember carefully. Very easy MCQs are asked. All you have to remember is up to 5 lakhs is allowed without authorization. Now what we are doing, this is export. That means you are allowed to send goods outside India up to rupees 5 lakhs. Third is your spare parts. Spare parts is, for example, any machinery. Now machines are so huge. Now there are small parts. Of course, the big machinery is made out of small parts. So these spare parts, if they are within the contracted warranty period, then it is allowed only post RBI approval. So for example, these goods, these spare parts, you are exporting outside India because you are giving someone a warranty that boss, within 1 year, if anything goes wrong, I will repair it free of cost or whatever warranty you've given. So if it is within the warranty period, then you need your RBI approval. And last is your, on this page, regards to replacement goods. So defective goods exported may be replaced free of cost. FOC means free of cost. Now this is allowed. That means if you had exported some goods and turns out those goods are defective, now you're calculating that, boss, it will be more expensive for me to go there and repair. What will I do? I'll send him a new good. I will send him a new machinery. So in such a case, these might be replaced free of cost. So this will be allowed. Okay. So we did 4 up till now for provisions relating to export. First was Samples are allowed without any limit, without any authorization. Then your gifts have a limit of rupees 5 lakh, up to rupees 5 lakh. Third is your spare parts. Spare parts require RBI approval if there is proper warranty. And fourth is your replacement goods. So replacement good can be sent free of cost, and this is allowed. Okay. Next, two items are your imported goods. So provisions relating to export of imported goods. That means you had imported goods and now you are exporting. So exported in the same form without authorization. That means if the goods you had taken as it is, if goods that you had imported and now you are exporting as it is without any change, that is exactly in the same form, then it is allowed without authorization. Export of such goods imported against payment in freely convertible currency would be permitted. Export will only be permitted. That means export of such goods will be permitted if export proceeds realized in the foreign convertible currency. That means your export proceed, that means whatever sale that you are doing, that should be received in your freely convertible currency. Export to notified countries will require more than 15% of value addition. So exports to notified countries. So there will be a list of notified countries. If you are exporting to those countries, you will minimum require minimum 15% or more value addition. That means if you had imported for 100 rupees, minimum you will have to bring in foreign currency worth 115 rupees. Only then will this be allowed. And next, last part is your repaired goods. So goods exported and found defective, imported for repair. So you had exported such goods. The goods, when they reach there, the customer said, "Boss, these are defective." So now what do you have to do? You will have to re-import these goods. So goods exported and found defective, imported for repair. Now you are repairing it back in India, and subsequent re-export. Now first you had exported, then you got it back in India. Now you are again re-exporting. So in such a case, it is allowed without authorization. You need not take authorization for this. Okay. I hope this chapter, how everybody I know is scared of, but it is not a difficult chapter. So I hope everything is clear till now. Now next is your export promotion scheme. This part is important because they ask for MCQs. Basically, these limits that I have mentioned over here, if you want, you can take a screenshot of this. Just remember these limits. Possible that they might ask this in MCQ. So status holder. So now what is the status holder? So applicant is the status holder. It is the status holder if it achieves export performance during the current and previous 3 financial years. So there are some certain amounts specified that, boss, you have to export this much. Only then we will call you a status holder. Okay. So this 3 years will be 2 financial years for gems and jewelry sector. So for gems and jewelry sector, instead of 3, it is 2 years. So you have to achieve your export performance not only for current year, but current year plus 3 previous financial years. Now category of status holder. So basically there's 1 star, 2 star, 3 star, all the way till 5 stars, and different amount of export limits have been mentioned. So if your export performance, if your export performance in US million dollars, this is US million dollars, okay, million has 6 zeros. So if in US million dollars you have exported, if you have exported 3 or more, if you have exported 3 million or more, you will be considered as a 1 star. Okay, so 1 star is 3 million, 2 star is 25 million. 1 star is 3 million, 2 million is 20, 2 stars is 25 million, 3 stars is 100 million, 4 stars is 500 million, and 5 stars is 2000 million US dollars. Okay. How will you remember these limits? 5, 25, 100, 500, 2000. So basically 3 to 25 is okay. Then 25 to 100, it is multiplied by 4. 100 to 500, it is multiplied by 5. And 500 to 2000, it is multiplied by 4. So 3 to 25, then multiply by 4, multiply by 5, multiply by 4, multiply by 4, multiply by 5, multiply by 4. How will you remember this? 3, 25, 100, 500, 2000. 3, 25, 100, 500, 2000. Okay, so these are your limits. 1 star, 2 star, 3 star, 4 star, all the way till 5 stars. Now your FOR value, your FOR value of exports in rupees converted in US dollars at notified rate by CBIC. Now what they will try to confuse you. They will give you notified rates by RBI. They will also give you notified rates by CBIC. Now you have to be smart and you have to use the rate that the CBIC has mentioned as on 1st April of your each financial year. 1st April of each financial year, whatever rate CBIC has prescribed, that rate will be used to convert any rupees to dollar transactions. Export performance necessary in at least 2 out of 4 years. So this performance has to be at least in 2 out of 4 years. Next is export performance cannot be transferred. So you cannot say that, boss, I have exhausted my quota. Can you transfer this excess that I have to someone else and give them a star? No, this is not allowed. It cannot be transferred. Say for example, I exported 12 million. So what will I do? I say that, boss, 3 is enough for me. I will get 1 star. There is no way I can get 2 star, but can you transfer this excess 9 million that I've sold to someone else so that they also get a star? No, this is not possible. Exports made on re-export basis is not counted. So if any export you are making on re-export, that means you have already counted it once, then it will not be counted. Again, we already studied cases of re-export. For calculation of export performance for star export house, exports by following to have 2 times the weightage. That means even if, for example, you exported for $100, we will consider that you have exported for $200 because it is given a 2 times weightage. Okay. So for this limit calculation, we will multiply it by 2. If it is a MSME, if it is manufacturing units having ISO or BIS, and last is units in your northeastern states, Sikkim, Jammu and Kashmir, and any agri export zone. So if any of these people, if any of these 3 people are exporting, for them basically your weightage will be double. That means if you sell good for $100, we will consider it for $200 while calculating the number of stars we can avoid it. Okay, please make sure I'm repeating it again and again. Please make sure you remember these limits. It is highly possible that it will come in your MCQs. Next is privileges of status holder. So you will tell me that, sir, you told me what a status holder is, but what is the benefit? What do I do of these stars? What are the benefits? So what are the privileges? First, authorization and custom clearance for both imports and exports on self-declaration basis. So your authorization will be given on self-declaration because they trust you. Next, exemption from furnish of bank guarantee in schemes under FTP. So wherever bank guarantees are required for normal people, they will not be required to. These people will not be required to furnish bank guarantees because these are respected people. They have certain export amount, so we trust them. The government trusts them. Therefore, you need not furnish a bank guarantee. 2-star export houses and above. So basically not your 1-star export houses, 2, 3, 4 and 5. So 2-star export houses and above are permitted to establish export warehouse. These people will be allowed to establish their own export warehouse. Basically 1-star is not allowed, rest everyone will be allowed. Manufacturer who is 3 stars and above. So any manufacturer, so you have to be a manufacturer and you have to be 3 stars and above, can self certify their manufactured goods as originating from India. They need not prove to anybody, they can self certify this. Status holders shall be entitled to export freely exportable items. So whichever are your freely exportable items, excluding your gems, jewelry, articles of gold, precious metals, on free of cost basis, subject to certain annual limits. So you will be allowed to export freely on free of cost. That means you need not bring any foreign currency also, that is allowed. Of course, there will be some limit. This limit has not been specified in your book, therefore I have not mentioned it. Next is your duty exemption and your remission scheme. So your duty benefits for inputs and raw material. Okay, so this is your first. So duty exemption. So now duty exemption will be under 2 cases. First is your advanced authorization, and second is duty free imports under authorization. That means these imports are of course not subject to duty itself because they are under authorization. So this is your case of duty exemption. Next is duty remission. Duty remission means you've already paid the duty and then when they give it back to you, they remit it back to you. Therefore, it is called your duty remission. So this is also your duty drawback. And next is remission of duties. Remission of duties and taxes on exported products. So any duty that you had paid on exported product, that will be given back to you. Okay, so first we did your advanced authorization. So so now we will be studying your advanced authorization. After advanced authorization, the second point we did was duty free import authorization scheme, correct? Duty free import authorization scheme. Okay, so this chart I've only made as a flow chart as to how our chapter will flow forward. Okay, so studying your advanced authorization scheme. Now what is your advanced authorization scheme? It is a facility to import input. You will be allowed to import inputs within 12 months from issue of your advanced authorization. So you will take an authorization beforehand, and for the next 12 months you will be allowed to import inputs which are required in the manufacture of export products. So you are making any product which needs to be exported outside India, but to make that product you need some import. You need some item which is outside India. So you will be allowed to import that item. You will be allowed to import an item within 12 months from issue of advance authorization, which is required in the manufacture of export product within 18 months from issue of your advance authorization without payment of import duty. Now what you have to understand, why the lawmakers have done this, why these lawmakers have done this. They are saying that, boss, you are anyway going to export. You say yes, I'm going to export. Now they say, well, we want to promote export. So if you want anything for your export, if you want to import anything for your export, you need not pay import duty on that, provided you satisfy these conditions. So now what is your condition? Subject to a 15% value addition. Subject to 15% value addition. That means whatever cost, whatever raw materials, etc., whatever everything you have incurred, there should be at least 15% value addition. There should be at least 15% of your profit. Inputs physically used in the export product can be imported without payment of custom duty, and IGST also has been exempted. Now you know, whenever you import goods, you will also have to pay custom duty, and after adding everything, you will also have to pay your IGST. Now import, as we said, without payment of import duty, as we said. So basically, when we say without payment of import duty, this means you do not have to pay any IGST, neither do you have to pay any custom duty. None of these you have to pay. Okay, so this is the point that you have to remember. Any export to SEZ unit. So if the SEZ unit, you receive the money in your foreign currency, that means you realize it in foreign currency. So any export to SEZ unit or SEZ developer. So in case of SEZ developer, it can be any currency, but what you have to remember, in case of SEZ unit, it has to be realized in foreign currency. So shall be taken into account for discharge of export obligations. So whenever you say that, boss, I am importing to sell it to this SEZ unit, it will be counted. Even though that SEZ unit is still in India, it will still be considered as export and it will be counted. That is what they are trying to say. Okay. Next is, what are the items which can be imported duty free against advance authorization? So against advance authorization, that means you've already taken the authorization that, boss, I will be needing these goods. I will be needing these goods to manufacture the item that I'm going to export. Which are these items? So first is inputs physically incorporated in the product. Now whichever input, which are raw materials, etc., whatever you will be requiring physically in the export product, all of that will be allowed. Next is your fuel, oil consumed to obtain the export product. To obtain the export product, all of that will also be allowed. Next is your mandatory spares required to be exported with resultant product up to 10% of CIF value. So if there are any spares that are required to be exported with the product, that is also allowed up to 10% of your CIF, that is your cost, insurance and freight value. Specified spices used for activities like grinding or sterilization, that will also be allowed. So these are the items which can be imported duty free, provided you have taken your advance authorization. Now how will you calculate value addition? Value addition will be A minus B upon B into 100, where A is your FOB value of export delay. That means when you are exporting, whatever amount you have received, that is your A. Next, B is your CIF value of inputs, CIF value of inputs plus imported material on which duty drawback has been claimed. So if any material you have imported and you have claimed duty drawback, that will be your B. Now A minus B divided by B will give you your value addition. Okay, so basically this is export amount, that is for how much price you have sold, and this is your CIF value of inputs. Now this is basically your cost price. Okay, so I hope now this formula makes sense to you. That is, SP minus CP will give you your profit. Profit divided by cost price. This will give you your profit margin. That is nothing but your value addition. Any item supplied free of cost, FOC is free of cost. So any item supplied free of cost by foreign buyer, nominal value will be added to your A and B. So if anything has been given free of cost by the foreign buyer, that will be added to your nominal. A notional amount will be added. Minimum value addition is 15%. Minimum value addition is 15%. However, 40 minimum value addition will be 50%. Okay, so usually it is 15%, but 40 it is 50%. Next is annual advance authorization. So annual advance authorization will be given to whom? Exporters who have export performance in at least 2 preceding financial years. So they have export performance. These tables that we have studied above. Okay, so exporters, if they have this export performance. So if exporters having export performance in at least 2 preceding financial years, entitlement of CIF value is your FOB plus your insurance plus freight. So entitlement of CIF value of imports shall be up to 300% of FOB value of exports in the previous financial year, or 1 crore, whichever is higher. So 300% of your FOB value of exports or 1 crore, whichever is higher. Okay. So this is an example that I've given. If you want, you can go through this. I will pause the video. I will stop the video once again so that you can pause and solve this, and then we'll move forward. Okay. This is nothing. Basically, they've given that value of inputs as rupees 10 lakh. So they're asking you minimum at what price they should sell. So this we already know that there should be a 15% gross profit margin. So therefore 15% of 10 lakh, 1,50,000, that is your 15% value addition should be there. Correct. Hence minimum FOB value shall be rupees 11,50,000. Then this is the second case that we were studying, that is your duty-free import authorization scheme. Now, what was the first scheme that we were doing? Your first scheme was your advance authorization scheme, where you take authorization beforehand. Second is your duty-free import authorization scheme. So it is a post-export facility to import inputs. Of course, this is also facility to import inputs, which will be used in manufacture of export of products within 12 months from date of filing of annual online application, without payment of your basic custom duty. Now what you have to remember, it is only basic custom duty over here. It is only basic custom duty. That means any other custom duty will be leviable, only basic custom duty will not be leviable, subject to a 20% value addition. So subject to a 20% value addition. In the previous case, if you remember, it was 15% over here. Now we are doing, there has to be a minimum value addition of 20%. Inputs used in export product can be imported without payment of basic custom duty. Remember, it is only without payment of basic custom duty. Your IGST will still have to be paid. Upper, if you remember, while we were doing this, without payment of custom duty, IGST also exempt, because over here they said without payment of import duty. So please very carefully hear the word what I'm saying. Over there it is import duty, over here it is only your basic custom duty. Okay, I hope this is clear. You will still have to pay IGST. After completion of exports and realization of exports, that means after receiving the money, request for issuance of transferable DFIA within 12 months from the date of export. What is your DFIA? You will ask. DFIA is your duty free import authorization. Okay, so DFIA is duty free import authorization. So 12 months from the date of export, or 6 months from the date of realization of export proceeds, whichever is later. So 12 months from the date of export, or 6 months from when you have realized the money. That means if you have not realized the money, you will not be allowed, because it is a condition of later. So 6 months from the date of realization of export proceeds, whichever is later. Transferable DFIA with a validity of 12 months from the date of issue to be issued. That means this that you have received, you can also give it to someone else. This is transferable. You are allowed to sell this. Now, what is the difference between your advance authorization and your duty-free import authorization? Because sir, you will tell me that boss, both of them are the same. We are importing. We are importing items for something that we are going to export. So now what is the difference? Now your advanced authorization is not transferable. This you remember we had studied, and your DFIA is transferable. As I told you over here only, transferable DFIA. So your DFIA is transferable. Next is under advanced authorization, you need 15% value addition. Under DFIA, you need 20% value addition. Advanced authorization is also available to gems and jewelry sector. Your DFIA is not available to this sector. Advanced authorization can be issued even if SIAM for that product is not fixed. So even if it is not fixed, it can still be issued. However, your DFIA cannot be issued where SIAM prescribes actual user conditions. So you do not have to focus on what SIAM is. Only and only if they give a only and only if they give a question like this, you can write these points. IGST under advanced authorization, IGST is exempted up to 30th June 2022. Now there has been an amendment made where all these dates, wherever there is 30th June 2022, you have to cancel it. So you have to read it as IGST is exempt, and under DFIA, IGST is not exempt. Okay, so this date has been removed altogether because earlier they were keep on increasing this date. Now they have removed this date altogether for your May and onwards exam. Okay. Next is duty remission scheme. That is your duty drawback. Okay. So duty remission scheme, if you remember, this was another part that we were discussing. Okay. That is your duty remission, duty drawback. This was your third part. So duty remission schemes, custom duty paid on input. This should be on. Custom duty paid on imports is given back to exporter of finished product by way of duty drawback. The custom duty paid on inputs, whatever input you had used, whatever duty you paid on that, it is given back to the exporter of finished product by way of duty drawback. Now duty drawback under section 75 and duty drawback under 74. Now 75 is granted when imports material, if you remember, we had done these section 75 and 74. So under 75 it is when import materials are used in manufacture of goods which are exported, while your section 74 is re-exported as it is. That means nothing has been done, it is re-exported as it is. If you remember, when it is re-exported as it is, 98% was refunded. And when your import material is used, there were your different all industry rate, special brand rate, etc. etc. I hope you remember all of that. Duty drawback is only of custom duty and not in respect of GST. That means only your custom duty will come under duty drawback. GST will not be given to you under duty drawback because that is different. Next is your scheme for remission of duties and taxes on exported products. What is your scheme for remission of duties? You hear the words carefully: remission of duties and taxes on exported products. So these goods, these products you have exported, now some duties will be remitted back to you. So based on the principle that taxes and duties should not be exported, based on the principle that taxes and duties shall not be exported. That means if any item is being exported, your taxes and duties shall be refunded back. Remission of amount in form of duty credit scrip credited in exporter's ledger account with the custom. So what we will do, that since this person has indirectly paid for custom duty now from whomever he has purchased, of course that person will also recover the custom duty. So this exporter has indirectly paid for this custom duty even though he is going to export this. So therefore what do? They give him duty credit scrip. It will be credited to the exporter ledger account with the custom. Objective is to refund currently unrefunded duties borne on the exported product, because this exported product will have certain inputs which might have been imported, on which duty might have been paid. However, since these are being exported, the government does not want the duty on this, therefore we are giving it back to you. We are giving back to you in what form? In the form of duty credit scrip. Value of said goods for calculation of duty credit to be allowed under the scheme shall be declared export FOB value of such goods, or 1.5 times the market price of such goods, whichever is lower. Okay, so when you are calculating the duty credit to be allowed, what is the value of goods that you have to take? Value of goods you have to take is your FOB value, that is the declared FOB value, or 1.5 times the market price of such goods, whichever is lower. Okay, so 1.5 times, whichever is lower. Refund in the form of duty credits would be credited in the electronic credit ledger in your customs automated account. This can be utilized to pay your basic custom duty on import goods. So this works as your credit only. So whenever you will be importing goods, you will have to pay some basic custom duty. So instead of paying it by cash, instead of depositing cash in your account, you can pay via the duty credit scripts that you receive. Next, duty credit scripts are freely transferable. That means you say that, boss, this is no use to me. What do? I do not import good directly. So you can sell it to someone else. It is transferable. So duty credit scripts are freely transferable. That means they can be transferred to other importers. Next, rebate given will have to be reversed in case of non-receipt of sale proceeds within the time limit. So this whatever thing we are giving back to you. However, if you did not receive the sale, see, that means you sell the goods outside India, you export it, but you do not bring back any foreign currency. If you do not bring back any foreign currency, if you did not receive any sale proceeds within the time limit, all these benefits that we are giving you, this will be taken back. And last part of this chapter is your following things shall not be taken into account for calculation of entitlement under the scheme. So these items will not be included. And with this, we are done with your FTP chapter. Okay. So we will just go through this list and your FTP chapter will just have your last page remaining. Export of imported goods in same or substantially the same form. So if you are exporting the imported goods, export of imported goods in the same or substantially the same form, it will not be calculated. It will not be allowed. Prohibited products, of course, not allowed. Supplies of products manufactured by DTA units to SEZ or FTWZ units also not allowed, because DTA is also outside territory. So if they are manufactured in DTA units and sold to SEZ units. Exports that are originating in third country but transshipped through India. That means it is actually originating through a third country. It is just touching India and then leaving. It will not be considered. Any products manufactured in EHTP and BTP. Goods which have been taken into use after manufacture. Okay, this was a separate point. Exports for which the electronic documentation in IceGate EDI has not been generated, or exports from your non-EDI ports. Deemed exports. Export products which are subject to minimum export price or export duty. Products manufactured partly or wholly in a warehouse under Section 65 of the Customs Act. Goods for which claim of duty credit is not filled in a shipping bill or bill of export in custom automated system. I'm running through these points because they usually do not ask these points, only and only if it comes in the question. So you have to remember that this have to not include. Therefore, I'm only reading these points. Products manufactured or exported in discharge of EO against an advance authorization DFIA specially issued under a duty exemption scheme of relevant FTP. Inclusions of exports made under these categories in RODTEP scheme will be decided later. Products manufactured exported by a unit licensed as 100% EOU in terms of provisions of FTP or by any of the units situated in your FTZ, EPZ or your SEZ. Okay, so these items shall not be taken into calculation for entitlement under the scheme. Now coming to your last part of the chapter is your export promotion capital goods scheme. Export promotion capital goods scheme. It is a facility to import or procure indigenously within 18 months from issue of authorization. Now which goods to import your capital goods? Up till now we were studying your imports of your inputs. Okay, so if you remember that these charts we were doing to import inputs. This is your DFIA. Over here also it was facility to import inputs under advance authorization. Now what are we doing? We are doing to import your capital goods. Okay. At zero rate of custom duty, zero rate shunya, in exchange to fulfill export obligations. So only provided you fulfill the export obligations, in such a case, you do not have to pay any custom duty on import of capital goods, because of course when you import capital goods, you will be producing goods out of it and you will be exporting it outside India. So if you meet the export obligation, in such a case, we will not be charging you any custom duty when you are importing this capital goods, because you are generating a lot of exports for India. Capital goods imported under EPCG authorization for physical exports are also exempt from IGST. Now, over here also you have to remember, up to 30th June 2022, this does not have to be considered. This date has been removed. Now, your specific EO. So now, as I told you, you have to meet certain export obligations. So now what is your, so there are two types of obligation. One is your specific obligation and second is your average obligation. Now specific obligation is 6 times of duties, taxes and cess saved on the capital goods in case it is imported. So if these capital goods have been imported, now for example you had to pay $1 lakh as duties, taxes, etc, etc. So now what we want that you get 6 times this amount of duty that you have saved, you get 6 times the amount of export. So therefore 6 times the duty, 6 times the amount of duties, taxes and cess saved on your capital goods, and 4.5 times in case it was indigenous, in case your capital goods was indigenous. Average EU, that is average level of exports made by the applicant in the preceding 3 license years. Period from the date of issue of authorization. Okay, so it is to be fulfilled in 6 years from authorization. So you have a time period, you have a time period to fulfill this. You are given 6 years. Okay, you are given 6 years from authorization. Authorization shall be valid for 18 months. Export to SEZ unit developer counted as your export. So if you are exporting to your SEZ unit or your export or your developer, SEZ unit or SEZ developer, it will be counted as export. Export for the purpose of your specific and average EU. In case where 75% of the specific EU and 100% of the average export obligation is fulfilled in half or less period than the original period, rest export obligation can be condoned. Okay, so if in case where 75% means 75% of 6, that will come to 18 by 4, 4.5. So basically if you do 4.5, if you do 4.5 times, if you do 4.5 times of your specific EO and 100%, that means 4.5% of your sorry, 100% of your average EO. In such a case, it will be deemed to be considered fulfilled if you do it in a period of half or less of the period than the original period. So this 6 years that we give you, if you do all of this in 3 years, then it will be considered as condoned. Last is your eligible capital goods. Eligible capital goods are capital goods in TKD or SKD condition, that is your completely knocked down condition, or your SKD stands for standalone knockdown condition, as far as I'm aware. Next is your computer system and software part of your capital goods are imported. Spares, molds, dies, jigs, fixtures, tools, refactories, all of these are eligible capital goods. Catalyst for initial charge plus one subsequent charge. Why? Which capital goods am I talking about? These capital goods. Which are the capital goods that you will be allowed to import? Sorry, this is complete knockdown condition and this is your semi knockdown condition. Okay, SKD is your semi knockdown condition. And capital goods for project imports. Capital goods for project imports, all of this will be considered in your eligible capital goods. Okay, now this will be, I know this will be visible to you only half. So these FTP notes I've also uploaded freely on the Telegram channel, so you can download it from there, don't worry. Okay, so I will just be reading it. So for EOU, EHTP, STP and BTP, they are given a facility to import. They are given a facility to import inputs and capital goods both. Okay, both of them are covered. Without payment, they do not have to pay any custom duty. So down, which is not visible, you can download these notes from your Telegram channel. Without payment of custom duty, in exchange to export entire production of goods and services. So whatever goods and services you produce, whatever goods and services they produce, if they export entirely, then you do not have to pay any custom duty. So now this should be a positive net foreign exchange earner. That means how much foreign exchange they are earning, that should be more than how much foreign exchange they are paying. NFE earning, that is a net foreign exchange earnings, shall be calculated cumulatively in a block of 5 years starting from commencement of production. Okay, your IGST is exempt. IGST is exempt Over here also, the date has been specified as 13 June 2022. You can cut that date. Units are allowed to retain 100% of export earnings in your EEFC account. Okay, I hope all of this you have studied this while studying your economic law also, and while in FEMA you studied EFC account. Sale of rejects may be sold in DTA up to 5% of FOB value of exports without positive NFE earning condition. Okay. Now goods can be sold in DTA, that is goods which are freely importable under FTP provided your positive NFE, and reversal of BCD availed as exemption, which certain things are not allowed, which are not allowed. Your pepper is not allowed, marble products is not allowed, and last part of this chapter are services provided in DTA. So this was your goods provided in DTA. Below there is another small box which you cannot see, that is services provided in DTA. So up to 50% of FOB value of exports. With this, you are done with your FTP chapter. I think this must be an half an hour lecture, and I hope you are much more aware of your chapter FTP, and all the best for your exams.